Hello again, everyone. This is Kevin with Forex-Trading In this video, we're going to discuss divergence. Essentially, in the markets, trends are basically composed of price swings. Momentum of those swings is usually a good indication of identifying trend strength. If you have less momentum, trend can be slowing down and lead to a reversal. It does not always go that way, but identifying those swings and the momentum related to those swings or lack of thereof can help you identify possible changes in the market. So usually momentum or divergence is ultimately a combination of the price of a particular stock or forex pair or whatever, in combination with another indicator such as RSI or a MACD. So essentially, you're looking at trend lines more or less on those indicators and price, and basically looking for the opposite directions of each of those. So as you can see here, there are multiple types of divergence depending on the direction of the market, depending on the indicator you use. So there's a lot of ins and outs of how you can use it. These divergent types kind of depend on the trend. You have regular divergence, hidden divergence, exaggerated divergence. But essentially, this, for example, regular divergence, and we'll show it on a chart here in a minute. You've got this is essentially indicating a change in trend. So you've got price that is continuing in a bullish manner, where your chosen indicator is essentially indicating that there's less interest in that trend. There's less bulls in that trend or in that market. So that indicator is essentially starting to turn bearish, and ultimately that trend will change and go bearish from that point. So, and likewise, on the opposite, you've got a bearish trend and price is bearish, yet your indicator is signaling more bulls are entering the market and pushing that trend to change to go bullish. So here in regular divergence, you can see again this is an ongoing bullish trend. You've got a higher high, yet your indicator has a lower high. And then likewise in a bearish market, you have a lower low, but your indicator has a higher low. So that's indicating that you're going to change in trend. Hidden divergence is essentially that hidden divergence is essentially where you've got a continuation of that trend, but your indicator is signaling. The indicator may have an indication of going the opposite direction, but hidden divergence will essentially signal that trend will continue. So this particular case is in a bearish trend where you have a lower high in play, continuing with your bearish trend, but your indicator has higher high. So that's a further sign of hidden divergence, which means that essentially this trend will continue to the downside. And then conversely, in a bullish market, you've got higher lows, whereas your indicator has lower lows, which will signal not a change in trend, but will signal a stronger continuation of that trend. And then exaggerated divergence is just where you have price essentially in a bullish trend, and then it's essentially hitting a point to where it just cannot penetrate, and then further, and we're looking looking for a change in the market. So your indicator is signifying with lower highs that this will turn into a bearish trend. And then where your price is seeing, call it double top or not penetrating this area, and will continue to change the trend and go bearish. And then it's just the opposite on the bullish side. So here we have a case of a regular bullish divergence. So we have which signifies basically a change in trend. So we have, this is the pound yen 4-hour chart. Here you can see we've drawn somewhat of a trend line. We've got a bearish market, a bearish trend, basically oscillating but still continuing bearish. Yet here we have plotted the RSI, Relative Strength Index, and you can see the bearish trend. We have lower lows, but when we look down here at the RSI, we've essentially drawn a trend line where we have a series of higher lows. So that's signifying that more bulls are entering the market, attempting to push this price up, yet price is continuing to drop. So at some point we're going to see a change in that direction, a change in that trend, to satisfy all these bulls that are entering the market. So, and then as you can see, this area does end up finally breaking through resistance levels and continuing and changing to a bullish trend. So that's an example of a regular bullish divergence. So looking in that same bearish trend, we can look in here and see a hidden bearish divergence, or a hidden divergence, which we're calling it hidden bearish divergence because that essentially signifies that we're going to continue on for a certain amount of time that bearish trend, even though our indicator is indicating that there may be a change in trend, but that's not the case. So here you can see our price in this bearish trend. We're making lower highs, so price is continuing to drop. Yet our RSI has, from this same time period, has started to make higher highs. So that's just indicating that bears are still the king here and still continuing to drive that price down. And with each of these high in your indicator, yet your lower high in the price, we can expect that trend to continue to move. So as you can see here, these three areas, we have higher highs corresponding to these three areas, or these three areas. And then when we get drilling down again, we get to a change here. So we essentially have a lower high and a lower high. So that now we can kind of see that maybe this bearish trend may be starting to change. And then obviously we had that regular bullish divergence where we saw prices continuing to move. And then obviously when you have both of those situations, you can kind of see how price is ultimately looking for a change in direction. You've got hidden bearish, which is signifying lower, and then you've got regular bullish, which is signifying a change in direction to go bullish. So ultimately something's going to give, and in this case the market ends up turning bullish and continuing on from there for a little bit, and then obviously you got to analyze each time frame, each period to decide how you want to trade that. So we have other videos to discuss how you can use divergence, especially in combination with other tools. Again, Fibonacci, trend lines, other methods of looking at of how you trade using all of these indicators and divergence to help you get a better idea of where to enter the market and what to look for, and setting entries and exits, and when to look at confirmation. Here you can quickly see we've broken a trend line in a bullish divergent market, so that can signal that this is indeed a good change. We've discussed other ways to trade this. You don't always know that this is actually the end of that trend, even though your bullish, your divergence signals that. But when we've broken a trend line, that's a good indication of you can start looking to enter the market. And obviously, we've broken and pulled back, and that's an excellent place to enter the market to go long, and still maintaining this divergence. So hopefully you can see how you can profit from that. So we hope you've enjoyed the video. Continue to look out for our other videos, multiple different trading methods, how to use divergence in other analysis techniques. Forex-Trading-analysis.com. Register for our newsletter. Sign up and subscribe to our free videos on YouTube. And we hope everyone has a good trading day.